Welcome to the show where you'll learn how to invest in mortgage notes, the savvy real estate investor's secret weapon to create cash flow without tenants and property acquisitions for pennies on the dollar. My name is Robert Haitha, founder of Fix Notes, and my mission is to make note investing ethical, profitable, and accessible for you. In every episode, we're democratizing the industry to put these powerful Wall Street assets into the hands of Main Street investors like you. So without further ado, let's get into this show where you're in good hands with my AI clone. Let's go. Welcome to the Fix Notes podcast, your guide to building wealth through mortgage note investing. In today's episode number 5, we're going to break down something absolutely fundamental to mortgage note investing, lien position. Specifically, we'll be talking about first liens versus second liens and why understanding the difference is so critical to your success as a note investor. Now, if you're new to note investing, this concept might seem a little abstract at first, but hang in there. Once it clicks, you'll start looking at every deal through a completely different lens. Let's start with the basics. When we talk about a lien, we're referring to a legal claim against a property, typically because someone borrowed money and used the property as collateral. Whoever records that lien first, usually the original mortgage lender, holds what we call a first lien position. Any subsequent loans, like a home equity line or a second mortgage, are recorded later and become second liens. And that order of recording is what determines who gets paid first if the property is ever sold through foreclosure. So here's the key idea. Lien position equals priority. In a foreclosure, the first lien holder has the senior claim. They get paid first before any second or third liens. And if there's not enough equity in the property to go around, well, tough luck for the second lien holder. They might get nothing. That's why risk and reward are so different between first and second liens. Let's talk about that for a moment. First liens are considered safer. They're backed by the full value of the property, and they have the legal right to foreclose if the borrower defaults. Because of that, first lien notes usually sell for a higher price and offer a lower yield. The trade-off is simple: lower risk, lower return. Second liens, on the other hand, come with more risk, but also more opportunity. Because they're subordinate to the first, there's always a chance they'll be wiped out in foreclosure. But they often sell at a steep discount, which means your upside can be substantial, especially if you know how to work with borrowers and structure win-win resolutions. So when investing in second liens, your focus shifts a bit. You're not just looking at the property, you need to understand the borrower. Is the first mortgage current? How much equity is in the deal? What's the borrower's capacity to make payments? Do they want to keep the home? In fact, a lot of second lien investing is more of a people business than a real estate business. Meanwhile, first lien investors tend to be more focused on the asset itself, the condition, the value, the market. If the borrower defaults, the investor can foreclose, take back the property, and sell it. So the property itself becomes the primary driver of value. With seconds, you usually can't foreclose, or at least you can't do so effectively unless the first lien is also cooperating, or you buy it out. So you'll often need to get creative. Maybe you negotiate a loan modification. Maybe you settle for a discounted payoff, or maybe the borrower wants to refinance or sell the property, giving you an opportunity to exit profitably. This is where strategy really comes into play. In a first position, you hold all the power. You can enforce your lien, foreclose, and recover your investment from the sale. But in second position, you need to be more agile. You might offer a payment plan, work out a forbearance agreement, or even collaborate with the first lien holder to reach a resolution. Sometimes you'll buy the first lien at a discount just to gain control of the situation. It's a different game. And for a lot of investors, it's where the magic happens. Now, regardless of which position you're investing in, due diligence is absolutely essential. For first liens, your biggest questions usually center on the property itself. What's it worth? What's the condition? Are taxes paid? Is it occupied? But for second liens, due diligence looks a little different. You'll need to dig into the combined loan to value ratio, or CLTV. That's the total of the first and second liens, divided by the property's value. If the CLTV is 90% or less, you've probably got some room to work with. But if it's over 100%, the property's underwater, and your note might be at serious risk. Also, you'll want to confirm the status of the first mortgage. If the first is seriously delinquent or in foreclosure, that's going to affect your strategy as a second lien holder. It all comes down to understanding where you stand in the capital stack and how much room there is between what's owed and what the asset is actually worth. So, to wrap this up, if you're just starting out, first lien notes might feel safer, and they are. But second lien notes, when purchased smartly and managed well, can generate outsized returns. The key is knowing how to analyze the situation, work with borrowers, and create win-win outcomes. Remember, lien position determines your level of control, your legal rights, and your potential upside or downside. So get clear on where your note sits, understand the risks, and build your playbook accordingly. And that wraps up today's deep dive into lien positions, first versus second. Hopefully now you see why understanding where your note sits in the stack is crucial before you ever send a wire. Next up, we're going straight to the source. In episode 6, we'll break down the anatomy of a mortgage note, what's actually inside the paperwork you're buying, how to read it, and why small details can mean big money or big problems. Thanks for sticking around to the end, and thank you to my trusty Rabah and the Fixed Notes team for putting together another episode. If you want to learn more and hang out with the real, not AI version of me, join our free school community at school.com/fixnotes. That's SKOOL.com/FIXNOTES. In the meantime, we'll see you in the next episode.